Welcome to my YouTube. Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we are going to talk about price to book ratio. So price to book ratio is one of the financial metric ratios that is used to determine if the company is worth it or not. So price to book ratio are used to determine if the company is overvalued or undervalued. They also have so many other uses for investors to make sound decision. So if you're new to this channel, please subscribe for more videos and I will appreciate your business. So now let's get in and talk about the agendas we are going to cover today. So we'll define what is price to book value. And then from there, we will calculate book value. And then once we have the book value, we will calculate book value per share. And once we have that, we will calculate the price to book value. And then we will talk about the uses of price to book value. So this is one of the ratios that they use to determine if the company is overvalued or undervalued and why should you buy them. And you will have to look at Yahoo Finance if you want to find the price to book value right away. So now let's get into the whole things. So we define price to book ratio as we use this ratio to compare the market price of the stock to book value per share. So it's saying how much does this stock trade compared to the book value per share. So the book value is always the value that represents the net asset, right? So you take the net asset minus liabilities, you get the book value. So let's see, like for example, most companies, when they go bankrupt, they have to sell their asset and then they pay the liability. And then if something is left, and then they will start paying now like the shareholders and all those stuff. So the reason why you need to know this ratio, it will make you determine if this company is really stable company. Is it a company, if it goes bankrupt, can they pay you back, or your money is going to just disappear like that? So let's look at example. So let's look at this hypothetical example of a company, and we will calculate these values and we will interpret them one by one. So first of all, before you calculate the price to book ratio, we have to assume that we have this company whose stock price is valued at $20. So the same company has the book value amount of 100 million. So there's difference between the book value and book value per share. And then we have the share outstanding for this company. So the share outstanding are 10 million. 10 million. So now let's go into the calculation. For you to calculate price to book ratio, you need this stock price and book value per share. So you only have the book value. For you to get the book value, you will take this amount divided by the share outstanding in this current market. So let's go through it. So now we can't calculate the whole book value. We already have the value, but if you want to know the formula to calculate the book value, it will be the total asset minus liabilities. But for now, we already have it. You can find it in your financial statements, but we have been represented with it. So it's like 100 million, which is the book value of that company. So now let's go ahead and calculate the book value per share. So for you to calculate the book value per share, you need the book value itself and divide by the outstanding shares that the company has. So if you get that, you will get the 100M divided by the 10M. So you cancel the 10M, the M, and M, and 0 and 0. So you are left with 10. So that is the book value per share. Let's go ahead and calculate now the price to book ratio. So for you to get the price to book ratio, you have to know the price of the stock that you are evaluating, or the company that you are evaluating, and then divide that one with the book value per share. So there is that difference. So most of the time, some students, they confuse the book value over the book value per share numbers, and then they get the wrong answers. So here you take the price per share divided by book value per share. So once you get that, you will get this amount, which is take the $20 divided by $10. So now you have the 2x. So this is the price to book value amount, which explain that the stock price of the company that you are evaluating is the stock price per share of that company is higher than the book value of that company. So 2x is the price to book value, which means this is higher than 1. And if it's higher than 1, this company is overvalued. And some companies that are overvalued, there could be those companies that have they have promising growth, right? Take, for example, Tesla. When it first started, you will find them, they have like a higher price to book value ratio because they the investors were more willing to pay more for that future growth that they were anticipating. That this company, the guy is ambitious, and then the even if the book value of the company is lower than the price of the share, they were willing to pay that different. So they were willing to pay that different. So this could be good or it could be bad. So you have to use this ratio with the other ratios, and then you make a final conclusion, because you cannot only rely on this, because there could be other factors that could affect the company, not only the price to book ratio. So now let's now interpret it. So what does it mean if you have a book value, price to book ratio that is 1? And what does it mean if you have the one that is less than 1? And what does it mean if you have the one that is higher than 1? So the one with that is under 1 is, it indicates that this company is undervalued. And who are people who like this thing? So the investors that invest for value, the investors that invest for the long term, like it, they use this undervalue. If the company is undervalued, and then they look at it as a good thing, because they see like this company has a quality asset, the asset value is higher than the price that they are paying. So they can now grab these stocks at a cheaper price, and knowing that in the future it's going to grow, or they will hand that dividend every month as they wait. So long-term investors or value investors, they like it. They use the undervalue PV. They use the PV to see if the company is undervalued and if it's the right time for them to enter the market. So the stock is undervalued, potentially offering a good entry point for value investors. So that's what it means. That's why some people say like, oh, the stock market is on sale, because they are seeing valuable companies that are undervalued when the price goes down. So it's a good opportunity for value investors to go in and start buying more shares of those quality stocks, quality companies that now are trading lower price than their book value. So now what about if it's the PV ratio is above 1? So in this case, it means like the stock is overvalued, right? It's just opposite. So in other words, the stock price is higher than the book value, right? So the number would be above 1, right? So it means like this company might be promising higher growth. This company might have all or outdated asset that do not cost that much or they don't value that much. So it depends. So once you're now looking at this, you could see if the company is really good. So if it's good company, all the other factors are met and you see it's overvalued, the PV is higher than 1, and then you can choose to invest in because you know, oh, this company is promising. So you will be willing to pay that extra amount to buy and hold this company for the future growth and you will profit in the future. However, if other factors are not met, and then you see the higher PV value, and then it could be a cushion. You have to practice cushion so you don't have to buy something and then 2 days later on it crash and the company is unable to pay you because if they have to sell the asset value is not even higher than the price that you pay. So that's what it is. The stock price is trading at the premium to its book value, reflecting the strong growth expectation or market hypes. So it could be the reason. But before you enter that market hype or the expecting strong growth, it has to make sense. So you have to look at other factors that will make you make that sound decision that this is not a bad company, even if it has like higher PV ratio. Now let's go ahead. What are the uses of PV ratio? We have already talked about some of these points like value investors. So value investors, they will use the PV ratio and the lower the PV ratio than 1, they know that company is undervalued and most good companies, if they go undervalued, if they are undervalued, is an opportunity for you to buy more so you can benefit in the future. So you identify and value companies that are good and you buy them. You buy when they are cheap and you hold them. And they are used to compare companies. So PV ratio can be used to compare companies so you can see which company is undervalued, which company is overvalued. And these companies, they are supposed to be from the same industry. Like you can compare financial companies, let's say TD, BMO, or RBC. So you can choose at that point. Let me check the PV ratio for BMO as compared to TD, as compared to RBC. And then you see, oh, so let me take TD because TD is a good company, but now it's undervalued. So I will take this opportunity to buy TD. So use it to compare different companies within the same industry. Another one would be for you to use it to determine potential risks, right? So like for the higher PV value, I think I've already touched on this. So the higher PV value combined with the lower return on equity, it could be a red flag. So it could be red flag and it could be that this company can go bankrupt, right? And if it goes bankrupt, you already see the problem. They don't have that valuable asset to pay you back that high price that you pay to buy those shares. So once you get this PV value that is higher, it means you are paying more than the value of the asset in their books. And if you now compare it with other ratio, you see the return on equity is not good. Maybe you're looking at the other one, like PE ratio or other things, and you see like everything is not to what you expected. And then it could be the sign that this company is way overvalued and it could have crash issues. It might like disappear and you lose your money. So if you like this video, please subscribe for more videos and I will appreciate your business. Thank you for watching and see you next time.